Hey there, today we're going to be reviewing chapters 11 and 12 over financial management and technology in business. Many things that you use on a daily basis have a computer system, such as video games, cell phones, or even automated toll collectors on your way to work. These have four basic components consisting of an input device, processing unit, memory, and an output device. Hardware is defined as the physical elements of a computer system. This consists of keyboards, cameras, microphones, speakers, or monitors. Software, on the other hand, refers to the set of instructions that is ran by the computer system. Businesses normally use many types of software such as word processing, spreadsheets, database, presentation, or communications programs. Computer networks are how businesses and schools link their computers together. This is done as common practice to share hardware, software, and data throughout these networks. The central processing unit, also known as the CPU, is the control center or the brains of the computer. The CPU has many tiny wafers which carry data using electronic pulses through the computer. A program is a series of detailed step-by-step instructions that tell the computer what functions to complete. This is the most common way to give instructions to a computer. Many of these programs are in the format of a computer language. These systems of letters, words, numbers, and symbols, which can be difficult to understand, are used to communicate with a computer. Operating system software translates commands and allows application programs to interact with the computer's hardware. The most common operating system software is Windows. Application software refers to programs that perform specific tasks such as word processing, database management, or accounting. Commonly used application softwares include word processing, desktop publishing, database, spreadsheet, and presentation softwares. Management Information System, or MIS, is a coordinated system of processing and reporting information in an organization. Computer systems and software are essential parts of management information systems. Computer-assisted instruction, or CAI, is the use of computers to help people learn or improve skills at their own pace. With CAI, students work to serve their needs and don't have to go to a school building for instruction. E-commerce, or electronic commerce, refers to conducting business transactions using the internet or other technology. Almost all functions have been adapted to this new electronic commerce. Robotics involves mechanical devices programmed to do routine tasks, such as those that are done in factories. One of the most common examples of this is used in assembly lines because of the repetitive tasks. Artificial intelligence, or AI, is a software that enables computers to reason, learn, and make decisions. This technology allows them to use logic similar to a human. Expert systems are computer programs that help people solve technical problems. Now, these are available for medical services, financial planning, and also legal matters. Piracy is the stealing or illegal copying of software, packages, or information. Copyright laws apply to software as well as books and music. A computer virus is a program code hidden in a system that can later do damage to software or stored data. Revenue is all income that a business receives over a period of time. Expenses, on the other hand, are the cost of operating a business. A budget provides detailed plans for the financial needs of individuals, families, and businesses. The startup budget plans income and expenses from the beginning of a new business or major business expansion until it becomes profitable. The operating budget describes the financial plan for ongoing operations of the business for a specific period. These are normally planned anywhere from 3 months to a year. A cash budget is an estimate of the actual money received and paid out for a specific period. These anticipate that cash will be coming into a business and that cash will be being paid out from a business. Financial records are used to record and analyze the financial performance of a business. There are many types of records such as asset, depreciation, inventory, accounts, cash, payroll, and tax records. Assets are simply defined as what a company owns. On the other hand, however, liabilities are what a company owes. Owner's equity determines the value of an owner's investment in a company. This can be calculated in the balance sheet by subtracting the total amount of liabilities from the total amount of assets in the company. A balance sheet is where the assets, liabilities, and owner's equity are listed for a specific date. An income statement is used to report revenue, expenses, and net income or loss from operations from a specific period. Payroll is the financial record of employee compensation, deductions, and net pay. Payroll records are the documentation used to process earnings, payments, and record each employee's pay history. A growing number of companies store these records electronically. A direct deposit is when the employer transfers the net pay of an employee into the bank account of that employee electronically. Financial performance ratios are comparisons of each company's financial elements that indicate how well the business is performing. Some important ones to note are current ratio, debt-to-equity ratio, return on equity ratio, and net income ratio. Current ratio is calculated by dividing your current assets by your current liabilities. This ratio determines if the business is able to pay their debts as they are due. This should be at least a 1-to-1 ratio. Debt-to-equity ratio is calculated by dividing a company's total liabilities by the owner's equity. This ratio is used to determine a company's financial leverage. It also reflects the ability of the equity to cover all outstanding debts in the event of a business downturn. Return on equity ratio is calculated by net profit divided by owner's equity. This ratio shows the rate of return the owners are getting for the money they've invested into the company. Finally, net income ratio is the value of total sales divided by the net income for a period of 6 months to 1 year. This shows the amount of profit for every dollar in sales for the period. Compare this ratio to the past years and other companies to see the growth and competition that your business has to offer.